started here. So I'm excited. I was a little worried with the weather. We might not get so many people, but this is good. So, and thanks to Mary for being our recruiter to class. So.
Good job, Mary.
Got me up.
I know you should. All right. So for those that are on Zoom, if you guys will throw in your first and last name in the chat box in the office, that'd be awesome. And then, so for class today, we have Jim Hogan with Inspiro that's going to be teaching. The idea of today is just to kind of get you a little familiar with what questions and things you should be asking, what the mortgage process looks like, and just basically how to make it be a smoother transaction, but so that you understand kind of what goes on with the mortgage side of things. And part of that for me, where that came from actually, was I would be training some agents and they would then send their people off to the lender. And then the agent then ends up calling and going, why is this taking so long? And so the idea of today is to have you guys understand what goes on so that you can then help tell your clients what's going on so that basically so that you can future pace them a little bit before you get frustrated or they do. So anyway, do you want to say something first, Crystal, before?
Oh, nope, I'm just here to support Inspiro.
Oh, okay, cool. Sounds good. So, all right, so with that, I'm going to let Jim come up and take over. I'll get your PowerPoint set up and ready to roll here for you.
Somewhere for you.
So that, yep.
You can only go up from here.
Yeah. Good. All right.
We
I
good?
think you're good to go. You guys
All right.
want lights on or off?
Lights on or off? Can you guys see the screen okay? Is that better?
On or off?
Front or back? Maybe.
The front off. I wish we could do that.
Oh.
It's either on or off. That's why I gave it the option, on or off.
Do off.
Okay with that. All right.
Off it is. Cool. Well, thanks for letting us be here. Like Russ had mentioned, my name's Jim Hogan. I'm with Inspiro, and I want to introduce Jenny Curtis. She's our processing manager, and she's amazing. She has a ton of experience, and she's actually going to help me teach. I think that you'll probably get more from her than me. She's a fabulous instructor and a great teacher and has a great mortgage mind. But nonetheless, we're here to help you, like Russ had mentioned, just to kind of go over the mortgage basics. You know, what is a mortgage? How does the process work? And how do you do it? You know, does anybody have any experience with the mortgage process? A little bit. Crystal does for sure.
Anyone done their own loan or bought?
Swin. Well, we're going to talk about it. So, you know, as we move forward, oops, what did I do here?
Oh, Jim.
I messed it up. So this is the forward and backward button.
Yep.
Okay.
Okay. Yeah, that one's
Okay.
forward, the other side.
Which one's forward?
So we're going to cover a lot. So we'll try to kind of go, you know, at your speed. If there's any questions, please just let us know. You know, what are you talking about? What does that mean? And we'll go over it. We want you to understand really what a mortgage is. You know, the basics from start to finish. How does it happen, right? We're going to talk a little bit about, you know, what your client, your buyers, what they go through, kind of their experience and why it's important to kind of understand this process and to help them, hold their hand a little bit, coach them a little bit, you know, through that process. Because, you know, the mortgage process can be pretty straightforward, you know, and people start looking online and they start researching and you start hearing things and, you know, that it can be really tough or really scary or, but it, you know, it can be very straightforward. It can be very easy. We just have to communicate and talk them through the whole process, right? Educate them, coach them. So ask questions, raise your hand. Jim, Jenny, slow down, or what does this mean? Or if you have any questions, just let us know. this is kind of our outline today. We'll just kind of go through it real quick again. What is a mortgage? We've talked a little bit about that already. You know, we're going to prepare you and your clients, you know, for that process. Definitions, types of mortgages. We're going to talk a little bit about out-of-pocket costs, closing costs. But step one, let's talk a little bit about getting pre-approved versus pre-qualified. We'll start off with that slide, but then they can, you know, obviously once they get through that process, they go house hunting, right? And during that, well, it's kind of, we'll talk a little bit about the credit approval because we've kind of started a different process, but we'll stick to this outline and then we'll kind of come back to that. Meaning getting loan documentation, we're normally, in a normal process, I'm just going to talk about it quickly. In a normal process, you do an application, you check their credit, you look at everything, right? Doing that, you can usually determine they're good. You know, they can qualify, they can go buy a home. So in a normal process, at that point, a buyer can go start shopping for homes, right? In Spiro, just recently, this year, the last couple of months, we've kind of taken a different approach. And we'll talk a little bit more about this, but I wanted to kind of clarify that because it's really important. We've decided to take a different approach where we will take the application, check their credit, and we're going to get all of their documentation up front right then. We're going to get their W-2s, their pay stubs, their bank statements. We're going to get all of that information and do what we call a credit approval. So your buyer is actually fully approved, with the exception of, you know, we'd have to get the appraisal and maybe some title work from North Star. But we want to get that jump started. We want to get that process done up front, completed, done, out of the way. So the buyer knows what they qualify for. You know, you have confidence going to a listing agent and saying, hey, here's an approval letter. The loan is fully approved. So that's something we'll talk about. But nonetheless, I wanted you to kind of get an idea of what we're talking about here. So what is a mortgage? A mortgage is a loan you get when you buy a home. You may not know, it is a financial instrument and it is secured against the property. And it's called a promissory note. And that note, it's like it can be traded. These notes, these mortgage-backed securities, it converts into a mortgage-backed security and is sold on the secondary market on Wall Street. So is anyone familiar with that process or even heard about it? Swen knows a little bit.
I have a question.
Yeah, please.
So is a promissory note more like, say, how is that related to like a trust deed, say?
Two separate documents.
Totally separate?
Yeah, separate.
Same transaction, but two separate documents. So the promissory note is not recorded on the property and the trust deed is.
Okay.
So that's the security instrument that is recorded.
Okay. So that's just the name, like promissory note is just like what you call.
It's just like a note, like if you went in to buy a car and you signed a note for repayment, that's your repayment terms for the promissory note. Then the trustee will have other information on it pertaining to the loan amount that's then recorded on the property.
Okay. Sweet. Thank you.
So that note that is secured, it is considered, you know, to kind of like a stock certificate. And that note is what allows banks, you know, mortgage servicers to buy and sell those mortgages, those promissory notes. So if you've ever had a mortgage, you may have noticed that maybe once in a while, your loan, the servicer changes. So meaning the company you make your payment to changes because it does become kind of like a stock and it can be traded. And there's big money in that. I mean, that's, you know, you take out $300,000 or $400,000 or $500,000, $700,000 mortgage and you're paying interest on that for 30 years. It's a big game that's tied to Wall Street. But I wanted you to kind of understand that because it's good to know, you know, as you're talking to clients and going through that process. The most common term is 30 years. And that is usually just because homes are getting more expensive and people want affordability. You know, they want a payment they can handle and not be house poor, so to speak. So, but you can do a 20-year, you can do a 15-year, you can do a 10-year. Those are available. And if you can do, I mean, if people can afford it, if people can do a 20-year or a 15-year, those are awesome, because they save so much money in interest over the life of that loan. But in my opinion, it boils down to affordability. So most people take out a 30-year mortgage just to have a lower payment. Mortgage payments are due on the 1st of every month. And you have kind of a window of about 15 days that you have to make that payment from the 1st to the 15th. After the 15th, there is a late payment, a late fee, I should say. And then after 30 days, there would be a late payment on their credit report. So you have 2 weeks, you have essentially 15 days from the 1st to 15th to make that payment without a late fee. And typically that late fee is like 5% or something of the payment. Jimmy, do you know exactly what it is?
It's 5 on conventional and foreign.
So, you know, on a loan, it could be $50 to $100 depending on the size of the mortgage. Let's talk a little bit now about preparing your clients for a mortgage. The biggest factor we look at, one of the biggest factors I should say, is your credit report. Your credit report, your buyer's credit report, it makes up a huge factor in our ability to give a mortgage to someone. Their credit score is, you know, the first thing that we look at. So we're gonna look at that credit history. We're gonna look at if they have any late payments. We're gonna look to see if there's any collections. We're gonna look to see if there's any bankruptcies, foreclosures, short sales. All of that stuff is gonna pull on their credit report. And so your credit score, your credit history is really important. I would just add that you don't have to have perfect credit, you know, but you do have to, you know, you have to, your buyers need to be aware of it, that, you know, a lot of times people don't know, they just don't know. So we try to remove that fear and just say, hey, look, let's take a look at it. Let's see where the credit is. Let's see where you're at. Let's see what it looks like. And you know, we can tell really when you pull it, the first thing we look at is that the actual score. We look at that score. And if it's 800 or close to 800, there's a really good chance there's really nothing derogatory on that credit report. It's probably really clean. But if you get down to 750, 700, maybe 680, maybe 650, 640, then we're going to start looking at that credit report a little closer and try to determine what is there, why is their score not 780? And, you know, so just trying to work, you know, any questions on that?
Is there like a bottom line of like what their credit would need to be in order to qualify for any loan?
The magic number, the kind of the low tier is 620.
Okay.
You want to be 620 and above. That doesn't mean we can, I mean, there are some loans that we can look at below 620, you know, if the shoe fits, but it creates some other underwriting guidelines that we have to look at closely to determine if they can, but usually 620. That's kind of the magic number.
Are you going to go over how that affects like interest rates and stuff like that?
I think we do a little bit, yeah. And if not, we'll come back to that.
Okay.
But it certainly does. I mean, let's just talk about it real quick.
Okay.
You know, your credit score, I mean, it will, or it does determine what kind of loan you can get. And to your point or to your question, depends on, it will affect their interest rate. I mean, a lot. So for example, I won't go too much into this because I think we do have a couple of slides on it, but if you're close to 800, let's just say you're above, there is kind of this magic number, you know, from FHA to conventional, both loans are great. Conventional is a great loan. FHA is a great loan. They both serve a great purpose, you know, for people. If your credit score, let's say, is above 720 and you have a down payment, we're probably going to look at a conventional loan because the interest rate's going to be really good, and you still have to put a down payment, right? So on a conventional loan, you have a 3% down option, but that's the minimum, but there's an income restriction. So typically, if your credit's good and you have a little bit of money down, we're going to look at a conventional loan because the rate's going to be very, you know, it's going to be good. Now on an FHA loan, you can go down into those 600s, you know, 680, 660, 640, down to 620. But even on an FHA loan, that credit score is going to be a little bit higher the lower your score is. Does that make sense? Does that answer the question, or did I?
Yeah, no, yeah.
Okay. Any other questions regarding that?
Speaking of like private mortgage insurance, so if I remember right, FHA has private mortgage insurance through the entire life of the loan, no matter what. But a conventional loan drops off at 80%.
Yeah. Yep. And so that's something we look at really close nowadays, because on a conventional loan, if you have a little bit of money down, 3% or 5%, let's say 3%, there's an income restriction, so you can still do it. But let's say you have a good credit score with 5% down, you're going to have mortgage insurance. Now, the difference between a conventional loan and an FHA loan, as it relates to mortgage insurance, is on a conventional loan, to your point, once that person either pays the loan down or over some time, there's some appreciation that's, you know, takes place. And in this market, there's been a ton of appreciation over the last couple of years. And so on a conventional loan, that mortgage insurance can come off. You can remove it once you get to that 80% threshold. It's actually 78%. But once you get there, you can call up the mortgage servicer and say, hey, look, I've paid my loan down. My home is worth a lot more. And so they'll help you, you know, remove the mortgage insurance. Whereas on an FHA loan, if you do an FHA loan, that mortgage insurance is going to be on that loan for the life of the loan. So we do look at that, but sometimes FHA makes sense just because of their situation, whether it's income or credit or whatever it may be.
And if you put a 20% down payment, is that?
Then you don't have mortgage insurance on conventional. It still applies on FHA.
Is that just kind of at the discretion of the buyer, or like no matter what, once you get 20% of your down payment, they just don't add on?
On a conventional loan, yeah. If you put 20% down, it's not required. Okay. It's important. Credit's important, and then work history is important. You want to, obviously maintain a good work history. We look at that closely. It's kind of the magic number is to have a good 2-year work history. That's something that is something we look at closely. It's very important. It really is. And Jenny may correct me, but Jenny, a 2-year work history is really important. And if you're in the same line of work, that's great. That's probably, I guess a little bit better, as opposed to if someone has a 2-year work history, but maybe has switched jobs a lot, and or maybe has switched different, an industry. Maybe, I don't know, maybe they worked in the airline industry and now they're in construction, or shed some light on that, Jenny. What do you, I mean?
So really with the work history, we're looking for, a steady 2 years of employment. But a lot of times, so like, let's say you're in the service industry. So right now that's not the best place to be in because a lot of restaurants are closed and things like that. So you have gone and you've gotten a job at Amazon, okay? So we're not gonna look at it and go, oh my gosh, we're gonna penalize you because you got a job at Amazon and you don't work as a waiter, because that doesn't make sense. But there would be probably a minimum of about 6 months on some kind of new type of employment that didn't have a work history attached to it. So I think it just has to make sense. If we're, looking at a doctor that is now a, ski instructor, probably not gonna buy off on that one because he's going from a professional line of work to something that is just, maybe a hobby for him. But if we're, we can actually make sense of it, that we're really good about going the extra mile to get other documentation, or give us a work history letter, tell us what you've been doing or why you took this job. so that we can, you know, build our case for approving a file.
The work history, I said credit is really important, but work history is actually.
Work history is also
it's important as well.
something number 2.
Yeah, credit, work history, and then, you know, the next point is, you know, whether you have a down payment or not. So whether you have money, I mean, having money is important, you know, it helps, you know, especially in this competitive market. If, you know, if you have some money for a down payment, you have some money for closing costs, and we'll talk a little bit more about this, but the reason that's important is, you know, on a conventional loan, on an FHA loan, there is a down payment required. If you're a veteran, if they're, you know, VA loans, there's 100% financing there. USDA loans, you can get some 100% financing there. But for the most part, otherwise, you do need a down payment.
Back to the work history thing, for us that we're self-employed, they say 2 years work history. Is that 2 tax years, or
Yeah,
does it need to be a complete?
What we're looking, so the question is if you're self-employed, what do you need to qualify? And it's kind of both, because we want to see a 2-year work history, but we also want to see 2 years of tax returns to verify that income when you're self-employed. That's a kind of a general rule across, I mean, every mortgage company across the country, you know, has to, you know, follow that rule, you know, and it basically what it says is the Fannie and Freddie Mac have kind of said, okay, look, if someone is self-employed, we want to see that they've been in business for 2 years, and then we want to see their taxes for 2 years, so we can see that they're actually making money.
So it's both.
Yeah, it's both. Yeah. And it's a little, you know, I'll take it one step further. It's a little tricky because we want to see that the business is doing well, right? So if the first year, let's just say, you know, hypothetically, first year you do really well, and then the second year it's not, you don't do as well. So there's what we call that would mean the income has gone down. We call that declining income. That's kind of a problem. So you want to be able to show on your taxes that it's at least steady. Like, you know, it's like it's doing okay that way. And if it goes up a little bit from that first year to the second year or the third year, then that's even better, right? We just don't want to see the income going down from that first year to that second year. It needs to maintain or go up, because otherwise there is a problem there. It becomes a challenge. And I'll take it one step further too. We're going to take those 2 years of tax returns. If you're self-employed, if you own your own business or you're 1099, we're going to average that income. You know, we're going to look at both years and come up with kind of an average. That's what you've made. And our processing team, our underwriting team will help us do that and say, okay, you're self-employed. This is what you do. This is what we believe your income is. And it's all based on the tax returns. We look at that really closely. It's a great question. It comes up a lot.
That answered my question as well.
Sweet. So as a real estate agent, we feel that, you know, I feel that it's really important for you to get with your clients, educate them a little bit, teach them about, you know, how to get a mortgage, but more importantly, have them go get pre-qualified. Have them go through that process. It's so important. And it can be done. We can do it face-to-face. If people want to come in, we can do it on the phone. We can do it on the weekends. We can do it at night, you know, whatever works for them. The technology is so good now that most of the time we're doing it through just our app. I mean, you know, we have an app that you just download onto your phone, and they literally takes them 10 or 15 minutes. That information comes right into our system, and we can start looking at everything. And once they hit submit on that application, it'll open up a portal where they can upload their W-2s, their pay stubs, their bank statements, their tax returns. But it's we'll talk a little bit about the difference, and I kind of did at the beginning, but the difference between getting pre-qualified, or in this case, pre-approved. We call that a credit approval. That's what we're doing. We want to get them pre-approved, or we call it credit approved all the way up front, just so there's no questions. And then you can go to a listing agent and say, these people are fully approved. All we need to do is get the appraisal and maybe some title work, and we can get this closed quickly. So it's kind of an approach we're taking and Spiro is taking. We feel like it'll be a little bit more competitive for you as you're out there.
So how quick are you guys closing the loan if they're totally approved and you just have to order the appraisal? Like if you order the appraisal on a rush,
Yeah, we do.
you guys
Typically,
Average
close
is-
in like 10 days.
Average is about, like, from start to finish, probably closer to about 20 by the time we're done. But the actual credit approval, the real pre-approval is about 4 days. So from the time they come in and they provide all their documents to us, and then it goes through the review process, it's about a 3 to 4 day turnaround.
okay. I don't think I'll spend a lot of time on these. These are really basic mortgage terms. Do you have a question?
Yeah, just about going back on that, and Spiro specifically, I heard from one of the leader guys, they're doing like free rushes with the Spiro, like the Everest Advantage. Yeah, what's up with that? Are you gonna get into that or?
Yeah.
Talk about it.
It's a good question. No, that's kind of what we call that process, the program. We call it the Everest Advantage program. That program is what we're doing up front. That we call it the process of that credit approval. That's what we're calling the Everest Advantage. So it's a program. Yeah, we're doing that. Once someone takes an application and we check their credit, and we know we have a program for them, we want to get their stuff. I mean, if they will provide their stuff quickly, to Jenny's point, we can get that process done. So they're fully approved without having, we don't have the appraisal yet, and we will order a rush because that, everything's about speed right now, and it's just, yeah, anyways. Do you have a question?
Oh, sorry.
No, you're
I'm
stretching.
Yeah.
Okay, I'm not going to spend a lot of time on these mortgage definitions unless there's something you see and you have a question. The LTV is the loan to value. That essentially just means how much money you put down versus what the home is worth. If there's anything you see you want to cover, I'm just going to go through all of these. Anything there that jumps out at you? We can send you this PowerPoint and then, if you have any questions, just call us. Come down. We're on the first floor. Call us, email me, email Jenny. We'll this stuff it's really good information, but we can come back to it if you guys have some questions on it. We'll move forward. These are all the terms that you hear if you're a loan officer or if you're a processor, underwriting. These are the things that we talk about. They're very applicable. They apply to every loan that we do. So yeah, we'll move forward. A couple more. There's only a handful, and these are it. And this is again, this applies to everyone. In the United States, we all have all the loans are all the same. Every mortgage company, we work with the same type of loans. We're all in the same playing field. A conventional loan is kind of the most, I guess, the most standard loan. I mean, that's that or FHA. And it's for buyers that have good credit and have a down payment. I mean, that's what it boils down to. FHA is a great loan because you only have to put 3.5% down, and your credits, your rate, your interest rate you can still get a pretty good rate, even if the credit score isn't really good. Now that in this market, in this climate, especially over the last year with COVID, FHA rates have gone up a little bit, depending on if your score is lower, if you get down to that 620, or 640, even up to 660, that rate is going to be a little bit higher than it normally would be. But FHA loans make sense. You just got to, every case is a little different. Every loan is a little different. Everyone's in a little bit different situation as it relates to those, to what we spoke about, their credit, their work history, and whether or not they have a down payment. So that's our job, is to review that information and try to determine what loan makes the most sense. Conventional loans, the interest rates are really good, but if you get down below let's say 700, down below 680, then your rate, it goes up quite a bit. So your credit score is really important as it relates to a conventional loan, just to get the best rate. If you want the best rate, then you need to have at least a 720 or above, and you need to have at least 3 to 5% down on a conventional loan. FHA rates are pretty good. And the difference, like we talked about, is that mortgage insurance. We look at that closely too. VA loans are really good. If you're working with a veteran, interest rates are really good, and they can get financed 100%.
And if I can say something right there, because it's my past experience that a lot of sellers in the market do not love accepting offers that are VA loans. That is where your pre-approval is really going to come into play, because you have an approved loan. It's not waiting for the process of it to go through the VA or anyone else to underwrite that. So that, in my opinion, is a really valuable tool, because you will hear sellers say, if it's between accepting a VA deal and a conventional one, they're going to take the conventional one. That's their mindset, and someone has educated them incorrectly on that, but that is out there. So, you can go to them and say, we actually have an approval for this loan.
But it generally takes longer.
Yeah, and they do have a little bit of squeamish on the appraisals, because typically VA is designed to protect the veteran. So if you're going in at a price that's escalated by $50,000 because you're bidding against somebody and the value comes in low, they are never going to have VA side with the seller. It's always going to be a veteran protection. And so that is the other part of it. If they get like, oh, the VA appraisers are gonna, lowball it, which isn't necessarily true, because they have to use true comps, but it is true in the fact that if it is overinflated for that particular market, they will come in more favorable towards the veteran than they will the seller.
One other question.
Yeah.
These values, is that essentially a number that you can't get a loan higher? Like, so
Yeah.
conventional, you're never going to go over that. FHA, I never knew that. And then so every loan that's over, 548,000 essentially is called a jumbo loan.
Yeah.
Those probably aren't that common, it sounds like.
They're becoming more, because homes are just, going up in value. Homes
Is
are
there a
expensive.
different, like, lending
Yeah.
group that deals with that?
Lending guidelines, yes. So on the conventional loans across the country, the maximum loan amount is that 548,250. What the government did is they've looked, they've canvassed the whole United States, and they say, okay, for example, in Utah, Summit County is expensive, Salt Lake County is expensive. So they've come up with another loan amount, and it's called a high balance conforming loan, a high balance conventional loan. So you can go up to 600,000, and you can still get a pretty good rate, and only have to put 5% down or 10% down. But once you go above 600,000, then you're, unless it's a high balance one, if you go above 600,000, then you are in a jumbo loan, and jumbo loans require a lot more money down. They typically require the buyer to have reserves, meaning money in the bank after the down payment. They usually, they look at, it's just a little bit different, but we do them. I mean, we can do jumbo loans. It's just, it's just another layer of processing and underwriting that we have to look at. Does that make sense?
Yeah, definitely.
Okay. Conventional, FHA, VA, jumbo, non-QM. These non-QM loans are coming back. I shouldn't say coming back.
They're being reinvented.
Yeah, if you guys remember The Big Short, that movie.
Yeah.
They talked about subprime loans, and that's what kind of, you know, helped the market crash in 2008 and 9. They're not called subprime loans anymore. They're called non-QM loans, but they're very safe. We would not look at them. We would not offer them to a client if we didn't feel good about it. But it is a good. They are an option, again, if the shoe fits and it makes sense. If it makes sense for them, for their in their situation, looking at their financial needs, they can be done.
Can you summarize what that is?
It basically means if you have a client that has to be self-employed, they have to be self-employed, and let's just say they don't show any money for whatever reason on their tax returns. The next best option would be we look at their bank statements. We look at their business and or their personal bank statements, and we look at their deposits, and we want to see that they're consistent. And they take an average over a year or over 2 years. If you do 2-year average, you get a better rate. But let's say, for example, today on a conventional loan, the rate, let's just say today, is around 3%. If you do this non-QM loan, it would be, instead of 3%, it would be 4.5%, you know, or somewhere in that range.
So you guys are pretty cautious about those.
Very cautious. It's got to make sense.
So kind of what I'm getting is these loans are for people who either one are just writing off everything
That's correct.
or drug dealers.
That's right. Yeah. Yeah. And there's a lot of them out there, we tell. I'm just kidding. Yeah, no, you believe it or not, there are a lot of people out there
Yeah.
that either write everything off or just don't, for whatever reason, show any money, take big losses, you know, depending on the business they're in and what they're doing. So another thing just to be aware of is, I mean, right now, the fixed rate, the 30-year fixed rate, the 20-year fixed rate, the 15-year fixed rate, they're low. Rates are low. They've been low. So I would say I'd say almost 100% of our loans right now are fixed rates, just because rates are so low. But over the last, since I've been doing this, and Jenny, you've been doing this for a long time, there are times when the market is, depending on what's happening with mortgage-backed securities, depending on what's happening with the economy, there are times where, right now we've been in this inverted yield curve where fixed rates are about the same as adjustable rate mortgages. So I'm going to tell the client, the fixed rate is much better for you. People, it's interesting because people start doing some homework, or they research on the internet and they say, oh, what about an adjustable rate mortgage? And you can compare the two. Okay, this is what a fixed rate would look like. This is what an adjustable rate mortgage would look like. And most of the time they see it. Oh yeah, let's do the fixed rate because it makes the most sense. But there have been times where, back when rates were maybe 8% or 7.5%, and the ARM was maybe 5%. And you're like, okay, well, if I can save 2%, I'm going to do an ARM. And the ARM just means it's only fixed for a certain amount of time. There's usually a 5-year ARM, a 7-year ARM, or a 10-year ARM. But I mean, maybe those will come back.
Is it beneficial for the lender mostly to change that, or the
It's tied to an index that's predetermined, the treasury bill. So it just goes up as the market fluctuates. It goes up with a cap rate of so much per year, and then a total life of the loan cap rate.
Mhm.
So the ideal situation is for someone to purchase with an adjustable rate mortgage and then refinance out of it as soon as the rates come down to something that's more favorable.
that was kind of my next thing. It's like, what would be better, just get a fixed rate and then do, just a full refinance anyway, instead of just having an ARM, or like,
Yeah.
so you can refinance. And
Yeah, I mean, it's mostly when rates start to go crazy.
Sideways.
So, when we're in like 8 or 9% fixed rate and you can do an ARM at 5 or 4, then, you can get someone into a house and then they just kind of have to write out the first couple of years and then refinance them when the rates tick back down.
Let me just back up to that one.
I have an out of pocket.
I
You
have a
know-
question.
Yeah,
I just would like to hear your guys' opinion on what you guys think the rates are gonna do here moving forward in the next year.
The rates are gonna go up.
rates will go up.
Inflation is a big part of that. And so, typically when there's a new presidency, you'll see rates will change up or down. Typically Democrats are always up. It just happens to be how they roll. But it's not, it's an indication of, that the federal government trying to stop that inflation. And so they have no choice but to make them tick up a bit. It actually long-term probably helps the market, even in terms of like the amount of inventory that is on the market right now. People are more like, oh, okay, well, I can sell my house because I have somewhere I can move to. Even if rates are, maybe 0.5% higher, the impact of that over a 30-year term is not that great. So I foresee that they'll go up towards the end of the year.
I think so.
They've gradually ticked up a little bit.
They at the end of last year into early this year and up until now, they've been trending upward.
Yeah.
And they were down close to like 2.5 on a 30-year fixed rate. And now that's probably closer to 3.1, 3.2 on any given day. And to Jenny's point, the challenge we have is all of the stimulus money, all of that money that's gone into the system that the government's pumped out there because of COVID to people, people are spending money, and what they're afraid of and what the concern is, and the numbers haven't been reported yet. The inflation numbers haven't even been reported, but the market, Wall Street, is speculating. And we see it, right? Gas has gone up, food, whatever, and homes have gone up, the cost of living is going up, and you can feel it, you can see it. And so the market is suggesting that, okay, inflation is creeping in, but they haven't even seen the actual reports. They don't come out until like May or June. So it's all speculation, but I think the reports will show a little bit of inflation. It's been very modest to no inflation up until now. And now when it's starting to show, we're all starting to see it and feel it. And the market is making that determination that there's going to be a little bit of inflation. Now, what will happen? COVID, we're coming through this vaccination process. It's getting better, but the concern is are we going to need another round of money? Are they going to print more money and put it into the economy? If they do, then that could maybe keep rates a little bit, lower than or about where they're at right now, maybe 3.5. I think they'll get to close to 4%.
That was my question.
I think that maybe even higher, depending on what the inflation numbers, where they come in at in May or June. I think the big thing now is once this money kind of people spend it and there's no money. I think the big question that there's, if you just Google it, about maybe a recession we go into because people, we're out of COVID and we're out of money. And so maybe we go into some form of a recession. If that happens, that would probably help rates come back down. But yeah, I think they'll go up.
Like June 30th.
Yeah.
No, I think you'll be closer to the end of the year, I think, before you see much of a tick in it.
Yeah, they've gone up. Yeah, they've gone up. My guess is by summertime, we're instead of 3.25, we're probably 3.7, 3.8.
Now, sorry, I know you guys probably have a timeline and everything, but like,
We're good.
I was always confused on like how interest rates affected people qualifying.
Mhm.
And because obviously if rates go up, not as many people are buying homes, even though home prices, kind of tend to come down because of that. So like, is it harder to qualify at a higher interest rate? Like when you guys,
Yeah,
It's harder if you are on the edge. So if you have a buyer that is just so tight, they have no breathing room, an 1/8% makes a huge difference.
Raises
So
their
there's,
current income.
there's options where
Payment's higher.
you could use seller paid closing costs to buy down your interest rate, pay your discount points and get the rate down to 3 if that's what you needed. Or they can get a non-borrowing or non-occupant co-borrower in some situations. So there's things that can help them with that, but yes, a little tick in a rate can be a deal breaker depending on how, strong your buyer is.
Even more so than a house, being 30,000 more.
Yes,
6
because that
months.
30,000 is also spread over 30 years.
Okay.
Where we're just looking at the condensed version of the payment, and we're saying all of their debt, including car payments, not medical insurance or things like that, but things that you pay a creditor for are included in that debt ratio. And so for some people, $50 is a big deal,
Yeah.
and that's, kind of what you'll see.
Shouldn't that in turn like lower house prices?
It will, actually, it does.
Yeah.
There's been a lot of
Less
talk,
purchasing
a lot of
power.
discussion about that right now, that, because, in our industry, in your industry, as a loan officer, as a real estate agent, we're seeing these rates go up. We're like, no, it's been so good. Rates are so good, but I follow a guy on Housing Wire who is like, just been doing it for 20 years. He's really good, very level-headed. And the takeaway is, hopefully it'll cool things off a little bit,
Yeah, and I mean, in relation to like, if you're going out and you're seeing more inventory, I mean, like I said, sellers are gonna be listing because they know that they can go somewhere. Where now they're not crazy about that because they're going, okay, if I get $50,000 here, I might have to do another 100,000 on the other end. And then I'm upside down in that at some point. So I think it does sort of even out the marketplace a little bit. And I mean, in comparison to, I'm gonna date myself, okay? My first mortgage was 13.05%.
Your own
I
personal
know
one?
how old I am. Yes, and it was a Utah housing loan, which was a slam and deal at the time because I think rates were like 15. So,
When was that? Sorry.
Long enough ago.
90s, the 90s. So I mean, if that like helps you understand that, people were still buying houses at 13.05% on a Utah housing loan because that was such a great deal. So, an eighth or a quarter or, oh my gosh, we're into the fours, the sky is falling, not happening, okay? 4 is such a decent rate that,
It really
it's
is.
all relative to like where you are at time. And it's like, things are booming in other areas, so it's like 4% is a great rate.
So the reason why we've had so many buyers available is because those interest rates got so low, so those people that were
Yes.
kind of on that line
Yes.
were able to qualify.
Because they were lower,
And-
yeah. So like somebody that couldn't have bought a $250,000 house 2
Yeah.
years ago, well, can't buy one now either because there's one. But
Yeah.
if there were one, they could qualify for it because the rates would come down just a little bit
So
below
their
that
debt income
threshold.
will qualify.
Yeah.
Right.
Okay. Thanks.
Want to go?
Sure. Which one's the forward one?
Just that
The
one there.
clicky thing? Okay. So we're just gonna go over this really quick. So these are just out-of-pocket costs, and I think when you're talking with buyers, we don't want real estate agents to be the professionals on mortgages, just like we don't want to write a contract for you. We'll look at it and we'll tell you what's missing off of it, but we're not gonna design a contract, just like you're not gonna design the mortgage. But there are key things that you can ask the borrower, and that is some of these, like, do you have a down payment? So if they don't have a down payment, step number 1, get them pre-approved. If they have no money, it's a waste of your time. It really is. Like, you're gonna go out and you're gonna beat the streets, and in this market, show them maybe, 4 or 5 houses. They're all gonna be way too expensive, and they're gonna be disappointed at the end of the day because they can't buy something that they absolutely loved. So, on top of that, they need to have their closing costs, which right now I'd say probably the biggest percentage of offers are not coming in with seller pays. So they're not writing seller paid closing costs into contracts.
You can use your 401k, okay?
Yeah,
Sure.
so you can use anything that's a liquid asset. It could also be a gift, so funds can be gifted
From a family member.
a family member. We do have DPAs, which are like our second mortgages for Utah housing loans, things that subsidize the down payment and closing cost. So they basically get 100% loan. So we have those available. And then the other fees that they need are just, their basic closing costs, inspections, appraisal fees, title
So-
fees.
Do you guys have like something different than just the Utah housing? with the
We have
DPAs?
another one called Chinoa,
Oh,
which is it's not 100%, but it will cover the down payment. And then they would either have to have assets of their own or get a gift letter for the additional funds. But we do have those available. Any questions on any of those?
They don't do a lot of DPAs right now.
No, we are doing them.
You do them.
Yeah.
Yeah, we do them. It's just, like Jenny was saying, as you're going out and presenting those offers to sellers, it's, or listing agents, they probably much they want cash, right? Because that seems to be the popular thing right now. But if not, we can do the DPA, if they're willing to let us do it.
And I think that there is something to be said for a real estate agent that goes out and presents to a buyer. Look, I have the ability to get you into a house with a 100% loan, because a lot of sellers really won't entertain a first-time home buyer offer right now. They're looking at cash investment, or someone comes in and says, hey, I want to give you cash for this. There's no way that a first-time home buyer can compete with that.
Yeah.
So we have to give them the best edge that we can by offering, extended programs that allow them to get into a house with little or nothing down.
Do you have guidelines on someone that would qualify for that, maybe, that I can get later?
Yeah, we can.
Yeah.
Yeah.
And one other point is just going back to our credit approval process and our ability to do that. It can compete with a cash offer,
Yeah.
and you may think that's crazy, but we can, and this is why if it were me, I would say, look, this client is fully approved. We just got to get the appraisal and title. We can close in 2 weeks. This cash offer, do they have the cash? They really have it? Can they access it quickly? Are they pulling it from an investment that's going to take time? Have they talked to their CPA? Those are the things that you'd want to ask, right? But our credit approval, we're just really, I'm like, anyways, I'll stop.
No, thanks. I appreciate it. And it helps.
Yeah, and the nice thing too is that if a file comes in a certain scenario and it doesn't work that way, at the pre-approval process, the credit approval, we will switch it to whatever makes it work. So we're not gonna come back and say, oh, hey, this guy can't do a loan at all. We're gonna figure out what loan can this person do. And if they're equipped to do that, then we'll issue the approval. So we're not just, saying, oh, sorry, we're done. We're trying to really make them work for you. Okay, so this is where we talk about getting pre-approved versus pre-qualified. So I don't know if any of you have experienced maybe getting something from a lender that says you've got an automated approval, like an automated system approval. And it's usually just attached to a pre-qualification, which means that I'm the lender, I looked at the credit, I, browsed over the income that the borrower put on their application, which may or may not be right, most of the time not. And then I just said, hey, based off credit and, what I see for income, these guys are good to go. So I'm going to issue a pre-qualified letter, and I may say that I received an automated approval. So the automated approval is through a desktop underwriting system that all of the lenders use. Garbage in, garbage out. Good stuff in, good stuff out. That's how it works. So you could get a pre-qualified letter and it could be absolutely 100% not accurate, unfortunately. Because all they're saying is that based on what I'm seeing right here in front of me, this guy looks good to go. The difference is we're going to do a pre-approval, which is you're going to have the borrower give us everything that we would require to do a full credit package, minus the appraisal and the title work. And then we're going to actually issue a commitment of approval. And that's going to be for the maximum that they can qualify for based on the information that we have.
Because they might not have told you about all the credit cards and ours
Right,
really.
right. Yeah. Question?
What is a VPA?
It's just a supplemental loan. I don't even remember.
Down payment assistance.
Yeah, it's like, something that supplements the down payment or closing costs combined.
That's typically tied to Utah housing.
Is it a separate loan?
It is.
So it's just for, compared to the mortgage, a very small amount.
Right.
Yeah. So it's usually a max of 6% of the total first mortgage amount.
Okay.
And that's if you're, trailing it behind an FHA loan. So again, we're talking about the higher the credit score, the lower the interest rate. The lowest we go is 580. Again, you don't want to go that low because you have pricing issues where your rate becomes quite a bit higher. Anything under 580, you'll have to go into one of those non-qualifying type loans where there's not any restrictions on things like that. This is how your credit score is derived. If anyone's ever seen their own credit report, you might wonder how you get a credit score. My opinion is the credit scoring is sort of
messed up.
BS.
Well, you know, the challenge we have right now is it's so easy to get on your phone and go to Credit Karma, or like one of your credit cards offers you a free kind of a credit score. And so, you know, we have people come in and saying, yeah, my score based on Credit Karma is 780. But then we pull it and it's only
680.
680. And that's just because it's that those websites and Credit Karma, those are all really good to kind of get an idea, to kind of track your credit, make sure there's nothing weird or crazy going on. But the formula they use compared to a mortgage pull with the credit bureaus is totally different. So I only say that just because you'll probably have people tell you, oh yeah, my credit score is 780. And I think the response is, okay, that's good to know. You know, but you probably need to get a mortgage pull just to see where they're at, because it's a different formula, different system almost. I wouldn't say system, but a different formula, sorry.
Yeah, a mortgage report is the 3 repositories pulled together. A Credit Karma is one repository, usually Equifax, the most favorable one. And so you're getting 1 score instead of your 3 combined scores. And so that's where it kind of gets a little bit odd for people, where they're like, oh, I should have a higher score than that. But this is kind of how it's evaluated. So you'll have 3 credit scores, and you could go on Credit Karma and see your, you know, highest credit score right now if you logged in there. So that is another really good thing as an agent, which I don't know that a lot of real estate agents do this, but they definitely should. And that is to say, do not buy anything, nothing. Do not charge on your credit cards. Do not buy a car. Do not go get a credit card for furniture. Once you've made loan application, don't do anything with your life in terms of financial.
Especially if
Just
it is a
hang out.
first-time home buyer
Yeah.
that's, like Jenny mentioned earlier, if they're on the fence, if there's little room to qualify based on income and debt, if they go take out another credit card for $1,000,
$15 is a big deal.
that could kill the deal.
Yeah.
I mean, it's that crazy.
These are weighted percentages, right? This is-
On these,
Yeah,
yeah,
okay.
yeah, there.
So I've had an issue before so you just talk, I know it's a little different on this part, but like seasoned money, like for down payment money.
Right.
That's another thing that we should be talking
Yeah, we'll
to
talk
people
about it,
right?
yeah,
Okay,
yeah.
good.
And I mean, like I said, we don't want you to try to be an expert on mortgages, because we don't want to do that for you. We're like, no, we don't want to write contracts and tell you where you're supposed to put it. That's your job. But it is good to do upfront homework, because I feel like a lot of agents, and right now it's so competitive, you're gonna be wasting a lot of time on people when they don't have all of, you know, the criteria that's really necessary to do a loan. So it's just a good way for you to kind of do a quick stop at the beginning. And definitely just say, hey, I want you to go to Inspiro and get a pre-approval. And if, I don't know what your process is if you guys, when you do your broker agreements, but that would be the time where I say, hey, this is where you have to get pre-approved. You signed a broker agreement with me, I'm gonna have you go to Inspiro, get pre-approved, and then I know what I'm gonna go show you if I can find anything, you know, at that point. Okay, we kind of talked about this to your work history. The job gaps would be like if I left a job and I had greater than 30 days missing, I would need to figure out like what was I doing during that time. Not a big deal. A lot of people have explanations for it, you know, change jobs, took a vacation, whatever, before I started my new one. Or so these are the documents that they'll have to provide to us for the pre-approval. So you can see we're actually getting everything that we would get if we were doing a loan that had an offer attached to it already.
You know, I'll just add to that. COVID was kind of interesting, you know, so the underwriting guidelines got a little stricter for the self-employed borrower, where, you know, there was all the PPP money out there. So if someone was self-employed and their company received PPP money, we have to factor that in. So that's something else to be aware of. If they are self-employed on the business, that does play into it nowadays.
Any questions on any of those? What we would be looking for? So this is the debt to income ratio, where it talks about their total debt. So the first debt to income ratio that we're looking at is we're looking at just the housing expense compared to their gross income. So that's the principal and interest payment, taxes and insurance, mortgage insurance, and HOA if there's a condo fee. So those are all in that first ratio. The other ratio is our back end ratio, which is everything combined, all of that plus their car payments, their Visa, anything that they have as a creditor. So this is just kind of an example of how you would get to the debt ratio. And I will say FHA is much more favorable on pushing the back end ratio up to about 55%, which is a lot. If you think of it, that's 55% gross of their income. So that's before they have their taxes taken out. So if you're looking at 55, it's really more like 65 or 70% of their
And that alone
income.
can,
It's scary.
can determine if you do a conventional loan versus FHA. I mean, that would be one of the, I mean, that's it, you know.
That is the deal breaker right there.
Other than a down payment, you know.
Yeah. Because we have people that have a down payment, but they have a low credit score or they have too high ratios. So our only option is to put them on FHA, which is unfortunate because they have to have that mortgage insurance for the life of the loan. But it does get them into the house, and at some point they can turn around and refinance that. So that's an option for them that, I mean, FHA has become much more lenient on their ratios than they've ever been before. But
You may have answered this already, but how is the mortgage insurance calculated? Is it like a percentage of the
yeah,
loan
so
amount?
FHA is 1.75% upfront. So if the sales price is 200,000, it's going to be 1.75%. And that's going to be added into the loan amount after the loan amount's calculated off of the 3.5% down. The conventional is based off of percentage of coverage. So it starts at a 95%. So 5% down, you're going to have a 30% required coverage, but it's monthly only. So FHA, you're going to have that one time of 1.7075, and then you're going to have 0.80 every month also. So you get hit twice on your government loan for your mortgage insurance
So it's almost 1% extra, close to.
in your payment.
Yeah, so if I have like a, interest of like 2.7,
Right.
add an extra percent, that's roughly what you can
Right.
kind of see the
Yeah.
whole picture as.
The average MI on, say, a $350,000 loan for FHA is going to be about $265 a month.
Yeah.
Around there. So you can see, like, over time that adds up, which is why if you can do a conventional loan, you can just get nailed with it monthly and not have that one-time premium financed in and then your monthly payment.
Unless the conventional loan was more than like 1% in interest, then you'd still be better off, right?
But yeah, technically, I mean, the way that the coverage works it works completely different on conventional loans because it works on the risk of the credit.
Oh, okay.
And so if they have a high credit score and they only have 5% down, that doesn't necessarily mean that we're going to hammer them with a 30% coverage. It may be 25. If it's a 3% down, it's 30. So they're factoring in like, hey, this guy has good credit, so I'm going to give him a break on the mortgage insurance. FHA is the same no matter what.
Yeah.
There's no variance on credit, worthiness for that. So right here, we're saying on a conventional loan that we like to see the total debt ratio below 40%. We do have a couple of ways to push that up to about 43. If they have reserves, so they have cash, liquid assets that they can liquidate if they got into a bind and had to, be forced to use it. But we do like to stay around that 40. And then that just tells you what is included. This does not have the HOA fee on it, but it does also include the HOA. So these are just the documentation items that we need. So when you're talking with your borrower, we actually have a flyer that I think
We'll send it out to you.
we'll send to you that outlines the pre-approval requirements that you can even give to your borrower, your buyer when you're setting them up to go look at homes. You can say, hey, be prepared that you're going to do a pre-approval process with Inspiro, and here's what they're going to need. Start gathering it so that they're not, waiting too long to do that. One thing that I would say is none of these are going to stop you from getting a loan. So like if they said to you, hey, I had a bankruptcy. Okay, you're not bankruptcy experts, you're not credit experts. That would be when you would stop and say, you know what, I have a loan officer at Inspiro that will take a look at your credit, see if your bankruptcy is within XYZ timing, and then, issue a pre-approval based off of that. So a lot of times people will think because they've had a bankruptcy, they're just a no-go for a house. But that's not necessarily true. So don't just set them aside and be like, oh, hey, they had a bankruptcy. I don't want to show them anything. Same with, assets. You can get a gift letter, you can do a DPA, you can, it's amazing how people can find money when they need it. That's what I've discovered. You have a lot of relatives when you need money. And then after the pre-approval would be your house hunting. This is you. Hey, good luck.
Divorce decree, is that because people might be paying out alimony or
Yes,
something like
yes.
that? Okay.
So a lot of times when we run a credit report, we'll see, and unfortunately it's a little bit one-sided to the female gender on this because we can see every name that you have used. Where a man doesn't change his name during marriage, he can be married 15 times and we never know that unless he actually disclosed it. But a female might have a last name Curtis or might have a last name Smith. And so then we're gonna say to her, have you previously been married? So the intent there is to gather up documents to add in kind of liability. So there is a section in the loan application where the borrower states if they're obligated for alimony or child support. Honestly, we would have no way of knowing other than if it was through recovery services or recorded some other way through the county. That's sort of an honor system in a lot of ways. So the pre-approval letter is what we've been talking about, where we're actually gonna give you a commitment for a loan. It's not just gonna be, I ran this through the automated system, this guy looks great. It's gonna be, we looked at every single little fine detail of everything and we can say that he could get a loan for this amount. The next thing would be just offering us the Rep C, so providing us that document in its entirety. Executed by all parties, if hopefully. And then also, if there's any addendums, we do need all of the addendums that go along with that and your broker agreement that shows what your charges are to the buyer. Section 24 on your contract deadlines. So if I was a real estate agent and I really wanted to do an excellent job in terms of writing an offer, I would call my lender and say, hey, I'm looking at writing this offer. Is there any way I can do this in 14 days? Is there any way I can do this in 20 days? So that you know what you're up against at the very beginning. I mean, we do rushes all the time. There's no reason to think we can't do that. But it is nice to have a confirmation that it can actually be done so that you're not flying by the seat of your pants out there saying, oh, I can get this done in 20 days and it turned into 30. And that could be the difference between the offer being accepted or not right now. Let's see, loan documentation. So for anyone that has not received a mortgage, is that the majority of people in here? How many people have their own mortgages? Or several?
A lot of them.
One of them, yay. The process of a mortgage is very detailed and it's become a lot more detailed now that there's government restrictions and entities that rule us basically. So the first real step besides gathering up those documentations is the actual process of the file. And so that's gathering everything that we have on the list that says your buyer needs to give us these items. Locking in the interest rate, if the borrower feels like it's a good time to do that. The loan officers will help educate your buyers. They will not tell them to lock or not lock. Because we don't have crystal balls, we don't know, tomorrow could be better, it's just kind of a gut feeling on their part, and they have to make that decision.
It wasn't last year, rates stayed so low,
Yeah.
throughout the year, that
There's-
having a conversation with the borrower about a rate wasn't
A big
It
deal.
wasn't a big deal, but then all of a sudden January hits and we go from 2.5 to 2.6 to 2.7 to 2.8, and then then we're a little bit more okay. We got to watch the market, and as they have questions, okay, what should we do? And rates are still so low. It's always a good time to lock right now still because rates are so low.
Yeah.
But there's
And you might have a pre-approval that says, hey, you can only go to 2.75
Yeah.
at this sales price, and if you go over that, then the deal's dead. So another reason, want to lock in the rate at the rate that we can do it at.
Is that a signed document?
It is a signed document.
And that's a fee to lock, it's $100 to lock, right?
There's no fee to
no
lock.
fee.
No. No, we don't have any fees to lock. The lock just has an expiration date of 30 or 45 days. So if it goes beyond that, we would have to charge to extend the lock if there was some kind of circumstances that we rarely have to do that. So, then through our app, oh, sorry.
Is locking in the rate the same for new construction as well?
No.
Okay.
So if you were doing new construction, most companies won't lock your rate unless you're doing like a one-time close, which means you're doing your construction loan and then incorporated into that loan is the long-term financing. You may be able to lock it that way. But up until that point, you would, from a buyer standpoint, they would come to us just as if they were buying an existing home. And they, depending on when it was finished, if it's gonna be done in 30 or 60 days, they can do a 60-day lock and secure it that way on new construction.
So otherwise, they have to wait until it's
Yeah.
about 60 days from being completed in order
I mean,
to
do
get
we do a
that.
90?
Yeah,
It's just
there
not
are some,
very beneficial.
Yeah.
the shorter the lock term, the better the rate.
Yeah.
So
Okay.
the longer the lock term, so if you go 30 or 45 to 60 to 90, the rate could go, let's say, from 3 1/4 to 3 3/4, or 3.7. So
But
So
what
you-
what I would say in that right now is because construction costs are rising.
Yeah.
If I was gonna build a house right now, I would lock it in for 90 days. If I thought that I was gonna be done in 90 days and take the chance of it not being done and paying an extension fee.
or rates could go up some more,
Right.
from
So
now
they could
until,
potentially not even qualify for
Right.
that home anymore
Right.
if the
Right.
rate
Yeah.
increases.
Right.
yeah, potentially.
Yeah,
Okay.
potentially that could happen.
So it's always a gamble in either direction.
It is.
It kind of is.
Yes.
It's hard. You have to look at that
So,
closely.
Do you have your Pronto? So we give the buyers a Pronto app that they can load on their phone. Through that phone, they'll receive e-disclosures. So all of the initial loan disclosures will come to them, and anything subsequent to that can be electronically signed will be delivered that way. So they'll get a prompt that says, "Hey, you have a document to sign," and they'll go in and they'll e-sign it. That is how we do all of our correspondence. It's through that system. Then the next thing would be for us to order the appraisal. Surprisingly enough, appraisals are not taking as long as they were. I think it's because we don't have a lot of properties listed, which I think to really sell. So we're at about 10 days realistically for appraisals. The title policy, North Star has agreed to rush every single title policy that we order through them. She's not here, but that's Crystal over in the chair right there that you cannot see. So they're a really good source for, even if you have questions on, like, you have a property, you're wondering, like, is this a condo? Is it a PUD? Is it, a townhome? You can take the address down to them on the first floor and give it to them, and they'll pull up the information for you. So a really good resource for other questions that you might have. The insurance, this is one thing that borrowers forget that they need, and that's their homeowner's insurance. So we do ask for it along the way about 100 times, and then finally right before closing we get it miraculously. And then the third-party verifications are just like if we're ordering employment verification forms or we're ordering additional, documents from the credit bureau or something like that. So these are all part of what a processor would do for the file. Review. That's my funnest part. Then the next step would be, it goes to the underwriting department, which those are the people that sign their names. So I will tell you that in all of the years, and you know how old I am now, because I told you what my rate was. In all the years that I've been doing this business, we have by far the best underwriters that I have ever worked with. I have had very candid discussions with them about disagreements of conditions, and we have always come to a very amicable conclusion, normally in my favor, I might say. So I would say that our underwriting is probably top notch in the industry for this valley, by far the best.
Are underwriters like in-house or?
Yes.
Okay.
Yeah, they're in-house.
Ours are. Sometimes they're
Ours
not.
are.
Some companies don't.
Ours are.
Sometimes
They have like service
Contract
centers.
it out.
They contract it out. Ours are in-house. We do send our jumbos to a different office, but they're still our underwriters, and we still have access to them. So these are kind of the 4 things that they're going to be looking at. They're going to be looking at the credit, analyze all of those, credit scores, what the findings, the AUS findings or electronic findings that we talked about, the desktop underwriting findings, And then they're gonna look at the collateral, which is your contract and your appraisal, make sure that it meets all of the agency guidelines. And then they just evaluate the capacity for the borrower to repay the loan. And then the next step is closing and funding. So we do something at Sparrow that a lot of companies don't do. And if any of you have been in the business for a little while, you might have heard the word closing disclosure. So a couple years ago, the CFPB decided that we needed to explain a closing statement better to the borrower. So they created a closing disclosure document that combines a lot of really useless information onto one page that they don't really understand, but they sign it anyway. But that is what we do in advance. So as soon as we get a conditional approval that has a property address attached to it, we will issue the closing disclosure. What?
7 days before.
Yeah, it's actually sooner than that. This
Yeah,
is
I
like,
thought it was like 3 days.
so
legally,
it
was
just
3
has
days.
to be to the borrower 3 days before consummation.
Signed.
Yes.
Yes.
Signed. So they receive that electronically again, but we will send it. So if I get a conditional approval today and my loan isn't closing for 2 weeks, I'm still gonna send out my closing disclosure. I'm gonna balance my figures with title so I know exactly how much my buyer needs. I'm gonna send a copy to them. They can, give you a copy of it. Title has a copy of it. And then that way everybody is on the same page. If we're short cash to close all of a sudden, it's not this big huge surprise, like we need a gift or something weird at the end.
We like to do it up front that way
Yeah.
because what happens is, and most companies I think are pretty good nowadays, but you have to sign it 3 days before you close. So some companies may forget to send that out, and you're getting close to that closing date, and then all of a sudden, oh no, we got to get that closing disclosure sent out because the government won't let us sign. They can't sign their closing documents until that's signed 3 days before. So that's why we try to. Jenny sends it out right away, so we remove that from happening.
So we try not to get in that situation. So the CD can be issued anytime after the approval of the underwriting package. So the conditional approval, once that's issued and it has a property address, then we can go ahead and send out the closing disclosure. Once we have a clear to close, so after all the conditions have gone back, we receive the clear to close, and the clear to close allows us to order the closing documents. So in my opinion, the one form that you should be looking at is your CD. So in your broker agreement, I believe, is a section that says you have the right to obtain any documentation related to this transaction and your borrower. If you're not asking your lender for a copy of the CD, you should be. Because that's where you're gonna go through and double check your purchase price, how much commission you're getting, how much the broker fee is. Is it $295? Is it $995? We're just going by what we have in there, and it may or may not be right. So that should be the one document that you're looking at. And if you need training on how to read it, I will help you. I will help you to do that, because that is a really important one. And then once the CD is issued, there's a 3-day waiting period before they can sign their closing documents. We wire our funds. We do what we call table funding. So we send our funds from our loan to title before they sign, which is really awesome because a lot of mortgage companies don't table fund. They don't fund in advance. And so it comes around to 3 o'clock in the afternoon and you're trying to get to the recorder's office, but you don't have funds from the lender. So you can't let your borrower move in over the weekend because there's no funds to give to the seller. So that is a really important thing to know, is that we do fund in advance. So you probably will never run into that problem. And then that's the part where it's going to be dispersed to the seller. The note, trustee, recorded. And then they get their keys. Ta-da. See how simple that was? Any questions? I'm not sure you have a lot of questions, but anything that you feel like.
Is there anything you wanted to go back on or any questions? Yeah.
If you guys just have like a definition sheet of the terms, like
Yeah,
I know like maybe 2/3 of them, but there's a third in there that
Yeah.
would be
Yeah.
useful.
they're in this, a lot of them, I mean, and yeah, some of them you'll never hear, you know, you'll never probably hear or understand APR, like, what is that? It's like, you know, it's the annual percentage rate, but calculated over the term of the loan, and it never makes any sense, and people don't really pay attention to it anyways. It's only applicable if you're gonna pay on the mortgage for 30 years, which nobody's going to.
Yeah.
But I mean, there's some that you will want to know what they are. And, oh, so-
You go ahead, you finish.
Go ahead.
On a conventional loan, let's say I put 5% down, and over appreciation, I get rid of the mortgage insurance.
Right.
And then the market drops. And the loan to value changes, and it actually changes in the worst. Does that mortgage insurance can ever come
No.
back?
No, and the mortgage insurance does not automatically come off at 78%. You have to contact your lender, and more often than not, they will require an appraisal to support that. It could be an automated one that they are willing to run themselves, or it might be one that you have to pay for, which is just usually like a small desktop one.
Yeah.
But no, you would never have mortgage insurance placed back onto the property once it's been removed.
And it's not refinancing, it's just reevaluating essentially.
Right, so they're just, all they're doing is they're saying, we now know that your house is worth, 22% more than it was when you bought it. So we're gonna go ahead and remove the mortgage insurance from your payment amount.
All the other loan terms stay the same.
Right, everything's it. So it's not a modification or anything like that that's changing in the terms other than that.
In my pre-licensing too, there's something, I don't know if I'm remembering right, I think it's called like the Homeowners Protection Act, where it like legally does have to drop off the loan at a certain period of time.
It technically, I mean, their quote is 78%. Even on government loans, if you put more down payment, it will come off.
Yeah.
Eventually, the monthly amount will come off. The one-time premium on FHA will not ever go away,
Yeah.
but that monthly amount could
Like
go
a conventional.
get off of the loan.
What's because there's a point you hit where it's like, okay, now you can take it off if you want, and there's a point where it's like,
78.
hey, we're taking this off right now.
78.
78 to 80.
All I'm saying is a
78.
lender is not going to voluntarily go through their servicing portfolio and call you up and say, oh, hey, you're at 78%, because they don't know it. So you have to take the initiative as the owner of the property to say, I'm aware that my property value has increased, so I'm asking you to remove my mortgage insurance.
If the property, if you disregard the property value, just the original loan amount
Right.
to the remaining loan balance.
Yep.
When
Same.
that drops to a certain percentage, do they automatically have to take it off? You have to request.
They will never automatically take it off because it's a servicing nightmare. Not because they can't, it's just because they have a portfolio of hundreds of thousands of
Sure.
loans. And so they probably have some kind of flagging system that says, oh, hey, this, balance is at 78% of what it was originally, but they're not gonna, contact, how servicers are, they're not very helpful. Really, they're gonna leave that stuff on there as
The
long
amount of
as they
stuff
can.
that they're getting more money.
Right.
For protecting them, yeah.
So, I mean, it's just their added protection is like, oh, if I have mortgage insurance on there for another 5 years, why do I care? I'm the lender. If for some reason I had to foreclose or something,
I have a question.
Okay.
How long would an appraisal be good for? Say like I got an appraisal today and it put me at like 80% loan to value, but with 6 months of payments, I'd be below. Would I need a reappraisal?
Yes, appraisals are only good for 6 months.
Okay.
So after that point, depending on what you are going to use the appraisal for purposes of lending, they're good for 6 months. There are some situations where we can recertify the value, but that kind of depends on what the market's doing at the time. But the good rule of thumb is that 6 months.
Okay, thank you.
Any other questions?
Thanks for coming.
Did we put our emails and stuff on here?
I don't think we did.
Well,
we'll get a list. Russ
Yeah,
will.
we'll email you our emails and some of the PowerPoint presentation, and then also we'll send you an example of the Advantage pre-approval, so that you can see what the letter looks like that you'd be taking to the seller. And then just come down if you have questions. Like, there's no dumb question. Like, I've been doing this forever and I still am learning things every day that I was like, I thought I knew that.
I'll probably come bother you about the closing disclosures.
Oh yeah, for sure. Yeah, we could even do a training.
Yeah,
Be great.
that'd be awesome.
Hey, any questions? Anyone else online?
Thanks.
Okay.
Thank you.
Thanks, guys.
Thank you.
Probably
Thanks.
What's going on?
You feel like you learned it something?
Yeah, it's good.
Yeah.
Thank you.
I'm glad they're good. This is so bad.
Tough right now, right?
I
I feel like
feel
I'm
Yeah.
so big, like I'm not sure if people in the last week. So I'm like, who are you?